Hey everybody, what is going on? I am sure that you have all seen headlines like this recently, where CMHC is predicting house prices across Canada to fall somewhere between 9 and 18%. Well, I was talking to some friends earlier today and over the last couple of days about this type of prediction and how the fear is like, hey, I'm going to wait for the market to fall. And we start getting into a little bit of a debate on, is it better to wait and try to time the market, or is it just better to go find the right deal right now and just dig into it? And what does that look like from a cash perspective? What does it look like from a savings perspective? What does it look like from a profit and return on investment type of perspective? So I just wanted to do a quick case study, and I'll try to rip through this as fast as possible on which you should choose, whether you should wait and try to time the market sometime over the next year or two is what they're predicting, or if you should just go find the right property right now and which one is going to be better in the short term as well as the long term. So this is what it's all about. Now, there are some easy, small assumptions made, but it's more so just to prove a point, and I'm trying to take a non-biased approach from it. But I am an active investor and I'm always just looking for the right deal. But one of the assumptions is like, your cash in is 120,000, which is the down payment. But we all know that you need a little bit of more money like that for insurances and closing costs, that kind of stuff. So anyways, let's dig into it. So if you wait, the average property that we buy is probably about $600,000. Now, that is the average income property price that we have here in Victoria, Langford, Duncan, the Cowichan Valley. That's tight. Sometimes it's a lot less because we do a lot of value add. Other times it's more if we're buying a multifamily, like a 4-plex, 5-plex, 6-plex, that type of stuff. But just for generality's sake and for this case study, this is kind of your average, and it's a 3-bedroom up, 2-bedroom down type property, which is, oftentimes your best kind of case scenario. So for a deal like this, you're going to need $120,000 down payment. Now, again, you're going to have some closing costs, that kind of stuff, but just let's keep it simple for now. And for Victoria, I don't see an 18% drop coming whatsoever. There's just so much demand here. There's so little supply, and we're so insulated from all the different industries that we have here. We're not just a one-trick pony type of town. We have government, we have tourism, not as much right now, but we have tech sectors, we have agriculture, we have just so much driving our economy, and everybody wants to live here. Let's face it. We talk to people all across Canada, and they all want to invest. They all want to live in British Columbia, especially here on Vancouver Island and Victoria. So I'm going to just use, for simplicity's sake, a 5% price drop, which is a $30,000 savings from your price point of $600,000 down to $570,000. But remember, this is only the price point at which you're purchasing. It's not actually the cash out of your pocket. The cash out of your pocket, your new down payment at $570,000 is $114,000, which is only a savings of $6,000. So it's not a huge savings. Like, you can go and make $6,000 in a blink of an eye, right? So it's not a massive amount of actual cash out of your pocket type savings. But anyways, let's keep going. $570,000 is your new price point, which is saving you $6,000. Really, it's only $6,000. But at this price point in Victoria, this is the lowest kind of price point, and it's in such high demand right now because it attracts new buyers, it attracts young families, it attracts downsizers, and it attracts people who are moving from other provinces. And so there's just so much demand, and it's so competitive that if properties come up that's an investment type property like this, you're going to be competing and going into multiple offers. So who knows if you're actually going to be saving that 5%, or if that 5% is going to be more relative to properties that are at the $700,000, $800,000, $900,000 type price point. But for simplicity's sake, again, I'm going to give it the benefit of the doubt. We're going to continue on as is. Now, if we keep going and explain, if you were to buy now instead of trying to wait and time the market, here's how it looks. So our price point is $600K. We're going to buy this income property at $600,000, which means we have $120,000 down payment, which is your standard 20%, giving you a mortgage amount of $480,000. Now, quick look at an amortization table. So here's 1 year of months principal paid down, which is going directly to your equity, giving you a $10,000 principal equity gain, or profit if you want to call it. So this is the recapture of your mortgage. Now, in an income property, it's your tenants paying down your mortgage. So at $10,000, of equity growth is an 8.4% year-over-year return on investment over 1 year. So how you get that is you go your down payment of 120 divided by your profit, which is your $10,000, and boom, you get 8.4%. Sorry, your profit divided by your down payment. And that's your equity side of things. On the cash flow side of things, our average cash flow for a property like this is $600. That's quite conservative. But again, giving it the benefit of the doubt, and this does include a massive contingency of $400 for things like vacancy, things like future repair and maintenances. And so this $600 a month is above and beyond that $400 kind of extra contingency. So $600 times 12 is $7,200 a year in annual passive income, which is a 6% cash on cash return. And again, just take your profit, divide that by your money into it, and there's your return. So if we account for the recapture of the mortgage and your positive cash flow that you've made, you have a positive net profit of $17,000 from just from buying the property. Now, you're still $12,000 short, right? If you saved $30,000 on your price point, you're still $12,000 short, or almost 13, but still you've made 17 grand. Nobody's, complaining about making $17,000. And again, keep in mind that this $12,000 of missed money isn't actually missed money, because you're only saving $6,000 on your down payment of cash out of your pocket. But anyways, let's keep going. There's one other thing I want to add into here. And most of the properties that we're ideally looking for are value add properties. Now, a value add property is something that you're going to renovate or take something from, poorly managed and improve the management or cut expenses, that type of stuff. And the typical type of deal that we're doing is, you're buying it at $500,000, you're, possibly a little bit of a beat up type property. You're putting $100,000 into it. Now, maybe that's, extensive renovations, or maybe it's just adding a suite. Let's just keep the numbers simple. So you're $600,000 again into the deal. Now, ideally too, we're buying this cash, doing renovations cash, and then that way we have a stronger position and go and put in just a mortgage on it instead of trying to refinance it, which is causing a lot of issues, and appraisals are coming in shorter, and it just takes more time. So ideally we do it all cash and then go to the bank and say, hey, here's our new property. We've done all this work. It's extra value. We have lease agreements in place. Give us a 80% loan to value mortgage. So let's keep on trucking here. And again, when we do renovations, it's not like you throw $100,000 in and you get $100,000 out. A lot of times you get a lot more benefit for the dollar. So for historically, what we've seen is if we do a $100,000 renovation, we get a $150,000 bonus value out of it, which is like a $50,000 extra. That's the profit that we make, which is, put $1 in, you get 50 cents back out. Now, for this particular case, I'm going to be a little bit more conservative, and I'm going to use a 25% added value instead of a 50% added value. So we buy it for $500K. We threw a $100,000 renovation into it, and we have like all the team in place to do this. So it's we know our numbers extremely well, and this is very realistic. And with a 25% kind of like dollar in for renovation, you get a 25% extra out. That gives us an after repair value, an ARV, of $625,000. So this guy here is the fun one. Now we've made a extra $25,000 just by doing some value add renovations to the property. So starting at the top, we might be able to save $30,000 from the price point, which is really, again, only $6,000 of cash savings out of your pocket, versus if you buy now, you got $10,000 in your recapture your mortgage, which is your equity, which your tenants are paying for, not you, because this is coming from the tenant's rent and not out of your pocket. Plus, you've got extra $7,200 in your pocket of annual passive cash flow above and beyond all your expenses, your mortgage, your insurance, your repair and maintenance, your vacancy allowances, etc. The whole works. And then you've got another $25,000 of equity here from the renovations that we've done. So quick recap to go through it all. You've got $10,000 from your recapture your mortgage. You got $7,000 from your cash flow. You've got $25,000 from your equity from your renovations, giving you a grand total, if you bought now and not waited, of $42,000 of profit instead of waiting and saving a potentially $30,000 on a price point, which is just $6,000 out of your pocket. So you're making an extra 12 grand if you don't wait, and if you act now and buy now. And so again, if it was just cash savings, you're making a huge amount more. Anyways, I just wanted to show that real quick because there's been so much kind of fear in the marketplace around, should I buy now or should I wait for some sort of correction? And again, like, take into account that, markets are different across Canada. This is our market here in Vancouver Island, where we're focusing is like Victoria, Duncan, Cowichan Valley, Lake Cowichan, Sauk, Langford, anything, on the south part of Vancouver Island. And so take into account wherever you're shopping, whether it be Edmonton or, who knows, London, Ontario, wherever you're watching from. Do this type of calculation for your own market where you're investing. And if you're curious on how we structure our deals, if you want to learn more about us, if you want to just get more educated on real estate as a whole, you can contact us two ways. One of the best ways is just hopping into our Facebook community. It's super active. There's daily conversations. There's multiple posts every day from investors from all across Canada. It's a little bit focused in BC, but we have a really strong network and tons of professionals in that space. So you can just hop onto Facebook and look up the REINVESTORS community, and it's a private group. Answer the 3 questions so you're automatically allowed in, or just send me an email. It's just steve@thereinvestors.ca. And I'm happy to walk you through how I did this. I'm happy to analyze your own deal if you're in a different market. And if you want to potentially invest with us, that would be awesome too. So hit me up, jump into our Facebook community, and I hope you guys are having a wonderful day. Stay safe out there and keep on investing.